Hey traders, this is Blake Morrow, and I have Mr. Dean Christians from Sentimentrader. I haven't talked to you in a while, Dean. Good to see you.
Good to see you, Blake. Thanks for having me on.
It's always my pleasure, and I love talking to veterans like yourself that've been in the markets for a long time. You've seen it, you've been there, you've done it, and how do you feel about this market where we're currently at? We've gone a long way, over the course of the second half of 2022. Are we going to continue higher, or do you think things are starting to turn where it might suggest that we might come down a little bit? What are your thoughts?
Well, look, I think here in the near term, we probably consolidate further, which is really what we've been doing really over the last sort of week or so. We've had a lot of studies that we've done over the last couple months that have had bullish implications over the long term. So that would be 6 to 12 months from now. We've had a washed out market coming in into the October low, and then a nice recovery where we've seen several breadth thrusts, in general just improvement in breadth, and all that is pointing to higher prices over the long term. But here in the near term, we probably consolidate, and we've got obviously a very important meeting next week, and we've got CPI in front of us. So, we're somewhat just sort of neutral on the market here in the very short term.
Okay, you're neutral on the market. So but let me ask you this: if things start to underperform, and you start to see stocks turn lower because maybe the Fed chair wants to, remain hawkish, we got some inflation data that seems rather sticky. What are the sectors that you're seeing right now that are really outperforming the rest of the market?
Right. So we've had several studies that we've shared on energy, which obviously over the last couple of years has been a stellar performer. But coming out of the low in October, we've also seen strength in industrials and financials. The typical defensive plays like healthcare and consumer staples have obviously held up very well, but to see industrials and financials perform as well as they have coming out of the low, I think is really interesting, and it really kind of calls into the question of where we are in the cycle, the business cycle. Are we sort of mid to late? If you're in the recession camp, or you're in the camp that we've had a growth scare correction and we're going to accelerate out of that. Normally coming out of a growth scare, or even a recession or contraction, you'd see stuff like technology and consumer discretionary lead. But we haven't seen that. So it somewhat makes me think that, again, we're sort of mid-late, probably more late cycle given what the Fed's been doing. And to see industrials and financials perform as well as they have, I think is really interesting.
Yeah. That is interesting. So, I keep going back to, the weeks and months and even years following the tech crash in early 2000s. And I know you traded through it. I traded through it. Investors were really seeking companies that actually made money and versus speculative type of trading, and that's the speculative type of sectors in the market, or even technology sector, if you will. And is that a similar parallel that you're seeing in this current environment?
It is. We've seen a number of studies we've run where it looks very similar to 2000 to 2002, where sort of technology and even some of the large cap discretionary names weighed on the S&P 500, whereas energy and industrials and even small cap performed very well in the early part of that 2000 to 2002 tech bubble. And again, we're seeing that parallel again, which I think is really interesting, and whether it plays out exactly like that cycle. That remains to be determined. But yeah, you're correct. I mean, people, at the end of the day, people need things like gasoline to drive their car from A to B. And, and look, energy had been beaten down. I think it got as low as maybe 2 to 3% of the weighting in the S&P 500. And so it's a place that, we've been constructive on. However, we did get a little bit cautious here of late, which I think would be something that we can kind of look at here today and kind of show you what sort of had us turn a little bit cautious in the near term on energy, even though we still, the long-term backdrop looks solid.
All right, well, let's see it. I'm interested to see it. I'm sure everybody else is too. And while you're pulling that up, if you guys like what you're hearing here from Dean, make sure you guys give him a thumbs up, subscribe to the channel so you don't miss any of this content. Make sure you check out Sentimentrader as well. So, Dean, let's see it.
Okay, sure. Okay, so this is a note we put out on energy on Monday, November the 28th. And, what we saw basically was on Friday, November the 25th, the S&P 500 energy sector closed within 3% of its 200 to 252-day high. But at the same time, crude oil had closed 38% below its 252-day high. Wow. So there's this huge divergence between, what energy stocks were doing and what crude oil was doing. And that's a pretty rare occurrence. I mean, you can only find 3 other instances, going back to the early 1980s. One of those was in 1998 with the Asian contagion. Another one of those was around the Gulf War. And then you had another one in 1986. So, with only 3 historical instances, it's really hard to sort of come, get an outlook that has a large sample size. So what I did was is created a model, and what we did was I looked over the last 63 days and I said, where does the energy stock closing price rank relative to all the other prices over that 60-day period? And what we found was it was in the 90th percentile, whereas over the last 63 days, crude oil was in the 0th percentile, meaning it was at the lowest level possible, whereas energy stocks were in the 90th percentile, meaning they were higher than 90% of all the other instances over the last 63 days. And when you see that big spread, which we see here in chart form, we pick up a few more sample sizes. And what it typically happens is energy stocks catch down to crude oil. And if we look at our forward return outlook here, what we can see is we see 7 historical instances going all the way back to 1989, and a week and 2 weeks later, S&P Energy 500 stocks are typically down, and then you see a bounce back. If we look at crude oil using those same signals, you tend to see the same thing. Crude oil over the next couple of weeks continues to fall. You can see here, 6 out of 7 times 2 weeks later, crude oil was lower. Wow. And you can also see, I think, highlighting sort of that Asian contagion period. Yeah. You had 3 signals in there, which, is kind of similar to what we're seeing now, with China sort of with the COVID policy and that impacting really all the countries around Asia. I think probably the best analog for potentially what happens with energy stocks and crude oil potentially could be that sort of Asia contagion period. Now, look, again, that's seven signals. If we expand our sample size, which we can do, this next table we looks at anytime energy stocks were in the 80th percentile or greater versus crude oil being the 20th percentile or less over that 63-day period, we pick up 32 signals. And you get a similar sort of outcome here. Over the next month, you see energy stocks are typically down, with fairly unfavorable win rates, and Z-score, which is just significance relative to history. And so, again, a larger sample size gives us the same message. Energy stocks should be weak here in the near term. And then the same thing with crude. I mean, crude's somewhat, down in the first week and then a little bit flattish. Interesting, crude oil, 3 months later is negative. So what we're seeing here with the divergence between energy stocks and crude oil got us cautious here in the near term. What plays out over a longer time horizon remains to be seen. But we went just sort of neutral and on energy stocks here in the near term, and of course they've corrected along with the market here over the last 4 or 5 days.
Okay, so but as they correct, you do think that they're going to resume that uptrend at some point, right?
Yes, yeah. And again, if you go back to sort of the original study, I mean, after sort of a 2-week period, you start to see the stocks they start to bounce. And 1 month later, 2 months, 3 months later, they're higher 71% of the time. And then 6 months later, they're higher 86% of the time.
Wow.
So
I was just going to say, doing the math here, in about it's been about a week. You talk about another couple weeks. That's just in time past the FOMC for the Santa Claus rally. So maybe the Santa Claus might bring you some energy stocks this season.
Right. Yep. Absolutely. So yeah, I mean, again, I would be looking to to buy the dip here.
All right. Well, Dean, I love what you guys do at Sentimentrader. Tell us a little bit more about what you guys do over there and how you help traders and investors, institutions globally.
Right. So for viewers that have not seen our work, this is a typical note right here that we provide. We use historical data to create a signal, and then we look at the forward returns off those signals to give us an edge. And typical note here would be, so what are our sort of key points about what we're writing today? We typically provide a chart so that people easily understand, sort of what we're looking at. They say, a chart's worth 1,000 words. And then we provide these outlook tables. And, the outlook table is I think what really separates us from other services. And, a lot of times with investing or trading, it's all about confidence and the confidence to pull the trigger, either to get in or to get out. And a lot of times, these outlook tables that provides you with the key statistics around trading signals gives you that confidence to pull the trigger. And at the end of the note, we typically summarize what our views are with what the research tells you, and that's sort of the bread and butter of what we do on a daily basis. We also have a website where we have all of our indicators, which are over 2,000 indicators based on sentiment, technical analysis, macro. You can chart all those indicators, and we have models that you can play with. We also have a backtest engine. So, if you wanted to run a backtest whereby you could say, well, when the percentage of issues trading above their 50-day for the S&P 500 crosses above this level, here's what your forward returns would be on a 1 month, 2 month, 3 month basis, and out to 12 months. So we have a lot of tools that individual traders, hedge funds, long-only portfolio managers, high net worth, family offices all use to give them an edge. And at the end of the day, what we're trying to do is just provide another input to our users and our subscribers to what they're already doing in terms of their own research.
Well, Dean, I appreciate you stopping by the Traders Summit and giving us some of your insights and what you're looking at here. And the takeaway is, A, I need to be following Dean on Twitter, and B, I need to be checking out Sentimentrader, and then C, I need to be also looking at buying energy on the dip. So, Dean, thank you so much for spending your time with us today, and I'll look forward to catching up with you first thing 2023.
Great, Blake. Thanks so much for having me on.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.